Please come to IAS 32 again. One more question we will solve, which is convertible debt with call option. So we will call it callable convertible bond. We will call it callable convertible bond. We have been solving questions on convertible bond. Now one more feature will be embedded in this bond. Embedded means it will be added to this instrument. That is called call option. What is a callable bond? What is a callable bond? The callable bond is a bond which can be called back by the company before the maturity. Is it right? Means a company can buy back this bond. Call back means buy back this bond before the maturity. So who is holding the option to buy here? The company or the investor? The company. So it is like a call option held by the company, which gives the company the power to purchase the bond before the maturity date. So who is the holder? Company. So who is the writer? The investor, the bondholder. So it will be deemed that the company is a call holder here and the investor or the bondholder is the call writer, because company has an option to buy the bond at some predetermined price on or before a certain specified date. So who is paying premium to whom? Indirectly, company is in short paying the premium to the investor, the bondholder, because the one who holds the option pays premium to the one who writes the option. But that premium that is paid by the company to the investor is somewhere embedded in the pricing of the bond itself. So now our task will be to make adjustment for this premium also, which is embedded in the pricing of the bond. So how are we going to tackle the problem where a call option is also embedded in the convertible bond? A compound instrument may also have embedded derivative like call option. For example, the instrument may contain a call option exercisable by the issuer. So issuer is having call option on the bond. Issuer can redeem the bond before maturity, can buy back the bond before maturity. So the value of any such embedded feature must be allocated to liability component. Whatever is the option premium will be allocated to liability component. Okay. The carrying value of the liability component is established by measuring the fair value of similar liability. Whatever we have learned, you continue to do that. Find out the fair value of the liability, present value of future cash flow. And what is the discount rate you will use? Another instrument which has all similar feature but without any option, neither callable option nor convertible option. So take that as a discount rate and find out what would have been the value of the liability, but without any associated equity component. So we got the value of liability. After getting the value of the liability, we are going to adjust the call premium. The carrying value of the liability will be adjusted for call premium. The carrying value of the equity component is then determined by deducting the fair value of the liability component from the fair value of the compound instrument as a whole. Okay. Now this is the compound instrument. It has equity, it has liability. That is compound instrument. First, to value the liability component, say it comes to 5. Total value of the compound instrument is 100. But this time there is a call option also embedded in this bond. Call option is like a premium paid by the company. Let us say the value of the call premium is 2 rupees. Value of the call premium is 2 rupees. How do you calculate the value of the call option premium? By using option valuation model, which you learn in SFM. For example, binomial model, okay, or Black and Scholes model. In the FR paper, this number is given to you. Only you have to know that this is the premium we have paid. This is my liability. So the net value here will become now 93. 100 minus 93 is the allocation towards equity. That's it. Only once they have asked this question, but otherwise they don't ask. So step number 1, calculate the value of the liability component. So under that liability component, disregarding the call, as usual, present value of future cash flow, and then adjust the value of the call. This reflects the inclusion of the value of the embedded derivative feature asset in the liability component. The reason why we are giving minus sign, this is a liability. Premium is an asset, call option premium that the party pays, which we are going to see in the next chapter, IFRS 9. Call option premium is treated as financial asset. So liability minus asset. Calculate the value of equity. Issue proceed minus first answer. Now why we have done it, we have written some logic also. This represents the equity residual arrived at by subtracting from the fair value of the whole instrument the fair value of the liability component, which includes the value of embedded derivative feature in the form of purchased call feature. That's it. Now there is a small question they have asked in the exam for 4 marks. Certain callable convertible debentures were issued at rupees 60. The value of similar debenture but without call or equity conversion option means just if I take the present value of future cash flow, I'll get 57 rupees. And as I said in the exam, they give you the value of call option as computed under option pricing model is 2 rupees. This 2 rupees will be adjusted against liability portion. So adjusted liability will become 57 minus 2, 55. And the total value of this callable instrument is 60. So can you find out the value of equity component? 5 rupees. Just for this much effort, you'll get 4 marks. Okay. But then you have to know. So right. Format is drawn, only put the numbers there. Value of the liability component minus value of call payable by the issuer. 57 minus 2. 55. Value of equity component. Issue proceed minus value of liability as per step 1. Write down the numbers in the sheet. 60 minus 55 is rupees 5. In the exam, this much is enough if they ask you. But if you want, you can present in one more way. Equation you can write. Proceed is equal to the total proceed is sum of liability plus equity. Only in the liability part we have to make an adjustment, that is host contract, bond minus call. Same thing we are doing, plus conversion option. Then 60 equal to 57 minus 2 plus conversion option value. Value of conversion option is 5 means equity component. And value of liability component will be 55. Okay, now this is compound instrument. Para 27 now, those who have done. What are the journal entries you will pass on conversion of compound instrument? Okay. Have you done the homework? 2 homework was given to you. Prepare ledger accounts. Those who have done, raise hand. 100% result. Conversion of a compound instrument. You have already passed the entry actually. What is printed here? On the maturity date, when the compound instrument will be converted, you will transfer the liability portion into equity. That's it. And in case if you have to pay the cash, liability to cash. And balance in equity component will be transferred to any other element of equity. Right? So upon conversion of a compound instrument, equity is issued and the liability component is derecognized. Journal entry: liability account debit to equity account. Liability account debit to equity account. The original equity component recognized at inception. The original equity component recognized at inception remains in the equity, although it may be reclassified from one line item of equity to another. This we have also discussed. Equity component is not remeasured, and once the instrument is derecognized, then the balance in that equity will be transferred to other component of equity. For example, it can be transferred to general reserve. It can be transferred to general reserve. Journal entry: equity account debit to equity share capital account and to securities premium account. On issue of share, first liability to equity. Equity to equity share capital and securities premium. If any balance remains, it will be transferred to any other component of equity. This is that entry where the investor decides to opt for conversion. If he opts for cash, refer your homework. Financial liability account debit to bank account. That entry we have passed in many questions. But suppose he opts for conversion, then the liability account debit to equity, and then from equity you issue the equity share that will be given in the problem, number of equity share into face value, remaining amount premium, whatever is premium, and if some excess remains, other component of equity. What about early redemption of a compound instrument? Early redemption. Possible early redemption? A compound instrument was issued for 5 years, but after 3 years only, suppose the company and the investor decides that it should be redeemed for whatever reasons, then what about the journal entry on this date for early redemption? That is my question. When an entity redeems or repurchases a convertible instrument before its maturity, that is without altering the conversion feature, the two parties agrees that we will redeem. The consideration paid, including any transaction cost, is allocated to liability and equity component at the date of early redemption or early purchase. Suppose the company tell the investor, you take this 1000 rupees and we are cancelling the liability. This 1000 will be apportioned between the debt portion and the equity portion, liability and equity portion. Okay, debt will be transferred to debt component, debt and equity to equity portion. Compare the amount transferred with the carrying amount. Carrying amount on this date in the date is suppose 910 rupees and you have transferred, let us say, 920 rupees to debt. So 10 rupee difference will be transferred to profit and loss. and you transferred 90 to equity, okay, 80 to equity, and some balance is already there in the equity account, both will be transferred to another component of equity but not to P&L account. So this difference between amount transferred and carrying amount P&L account, this difference will be transferred to other component of equity. So I think I have written a note also for you. To the extent the amount of consideration allocated to liability component exceeds the carrying amount of the liability component at that time, means book value, the loss is recognized in P&L account. If the amount transferred to liability component is less than the carrying amount, gain is recognized in P&L account. This is for liability component. The amount of consideration allocated to equity is recognized in equity. No gain or loss will be recognized in P&L account. The balance in equity component may be transferred to another line item within the equity only. Okay. Now we'll solve one question on this matter. Check whether this question is there. Write down. 38 number. Okay, the moment I said write down, you were able to locate fast. I said it is there, but you said no, it's not there. So then write down. Question number 38. We will solve together. This example is for understanding what will you do if there is a early redemption of a compound instrument. The topic is early redemption of a compound instrument. The amortization schedule of the instrument is set out below. Date 1st July, cash inflow 10 lakh, and they had bifurcated this into liability and equity. In the exam, you will have to do this exercise first, okay? By preparing a table of statements showing calculation of financial liability and equity. We have done that around 25 to 30 questions. And then every year they are going to pay the coupon, then they are going to recognize the effective interest, they will change the carrying amount of the liability, okay? Equity is not changing. Equity is not changing. First year, second year, same calculation. Third year, they've redeemed the liability, okay? Balance in liability becomes zero. Equity is not changing. This is your original schedule. This is your original. If things would have moved as per the original plan, this is how the liability account would have moved over 3-year period, right? But things have changed. Assume that D Limited has an early redemption option to prepay the instrument at 11 lakh on 30th June 2003. 30th June 2003 means over here, after 2 years only. Is it right? So at this point, it will pay 11 lakh rupees and it will redeem the convertible bond. Calculate the value of the liability and equity component. Assume that interest rate on 30th June 2003. This is the date. For 1 year maturity is 5%. So what you will have to do, you have to again calculate how much out of 11 lakh will be allocated to liability and how much will be allocated to equity. So first find out the liability. How will you find out the liability? How many years are remaining now? 1. If you are redeeming on 30th June 2003 and the maturity date is 30th June 2004, it means we are 1 year only away from maturity. We are only 1 year away from maturity. So on maturity, this bond will pay 10,60,000 to the investor. And we have to value this bond 1 year before the maturity date. So at what discount rate you will value? At the market rate of discount on this date. So on this date in the market, similar instruments offer you 5% rate of return. So 5% discount, 10,60,000 divided by 1.05. Try at least. 10,60,000 divided by 1.05. 10,09,000. 580. 523. Okay. As per the study module, 523 is there. This out of 11 lakh, 10,09,523 is to be apportioned towards liability. So what is the amount you will apportion towards equity? 90477. 90477. That's it. But the value of the liability on this date is this much, 972,476. And you are allocating 10,09,523. So there will be a loss of 37,047 rupees. The difference between the carrying amount of the liability and the amount allocated towards the liability. Amount allocated is more. You are paying more than carrying amount. In case of liability, if you are paying more than carrying amount, there is a loss. So that loss will be recognized in profit and loss account. And the balance in equity is already 75,939. And plus you are going to allocate 90477. Is it right? So equity account also will transfer to other component of equity. That okay. So see the answer. First, there is a note. Amount paid 11 lakh split in the liability and equity on the date of early redemption. If the market rate of interest has changed, take the revised rate of interest and then calculate the present value of remaining future cash flow at 5% discount rate. Okay. So see the calculation. First, they have calculated in the note present value of this principal amount 10 lakh divided by 1.05. Second line, they have calculated the present value of coupon 60,000 divided by 1.05. Suppose you don't have time in the exam, one line only. 10,60,000 divided by 1.05. So that gives you the fair value of the liability on that day. Is it right? 10,09,523. The rule of allocation now also will remain the same. Out of 11 lakh, first we will apportion to liability this amount. So remaining amount is for equity. Out of 11 lakh, this amount is for liability. So the remaining amount will be allocated to equity 90477. Now write down the journal entry, which is not written in your notes, I think. Yes or no? Written. Write down. If they ask you past journal entry, then you can write this journal entry also. First entry, write down financial liability account debit 972,476. This you will find in the question itself, book value. So that account will close. Payment made towards liabilities 10,09,523. This figure you will take from here. Whatever you will write in your notebook, you will take it from here. And the balancing figure, profit and loss account, debit. Balancing figure 37047. You should be able to solve this complicated problem, right? And then we will pass the entry equity account debit. Tell me how much was the balance in equity in that question? Equity 75939. 75939. Reserve and surplus account debit balancing figure. And to bank 90477. This 90477. So dear student, what is the amount you will adjust in reserve and surplus? 14538. 14538. So the difference in the equity account will be transferred to any other reserve account. Is it right? So that I have written a note. The difference in equity account will be adjusted against other equity account. Okay. So either you can present in the journal entry or you can write a note below later. Now, one more question. (46) number. On 1st January 2009, A Limited issued a convertible debenture face value ₹1,000, maturity date 31st December 2018, the debenture is convertible into equity share. The debenture is convertible into equity share of A Limited at a conversion price of ₹25 per share. Interest is payable half yearly in cash. Every 6 months they are going to pay interest. Half yearly, underline, be careful. Okay. A small correction, issued a 10% convertible debenture. 10% convertible debenture. Interest rate is 10%, half yearly in cash. Now write down. At the date of issue, A Limited could have issued non-convertible debt with 10-year term bearing a coupon interest rate of 11%. Bearing a coupon interest rate of 11% means without conversion option, market rate of interest is 11%. This much you can solve. This is the first part. Normal question, you can divide the liability and equity portion. But then the story changed suddenly on 1 1 2014. Convertible debenture has a fair value of 1700 rupees. Entity A makes a tender offer to holder to repurchase the debenture for rupees 1700. So what is the redemption price? 1700 on 1/1/2014. So early redemption of convertible debenture. Okay, comma, which the holder accepts. Which the holder accepts. The market rate of interest. The market rate of interest on this date for a 5-year term debt is 8% per annum. Is 8% per annum? This is 11% per annum. Because it's half yearly, so I have to mention it. So in case if you want to issue another instrument in the market today, the market rate is now 8%. Question is, pass journal entry for the repurchase. Since you are intelligent student, yes or no? Yes, at least say yes, which can later be challenged. But same problem which you solved just now, but previous problem had given lot of information within the problem itself, right? Solve. Give me the entry on repurchase. I'll give you 10 out of 10 if it is right. Entry already you have written in the previous question. See this question. On the repurchase date, you have to pass this entry: financial liability account debit, P&L account debit, either on debit or credit side, I don't know, to bank account, and then equity account debit, reserve account debit to bank account. Only give me these 6 numbers. You want to try? Okay. Such a brave student. Give me those 2 journal entries which you will pass on 1/1/2014 on early redemption of compound instrument. Open challenge to all of you. And the format is already known to you, previous problem. That is the base you take. How they have done in that previous problem. Okay, time over. Open book exam only. You have the previous answer. Take that as a base and use this question for solving that problem. Anybody who is able to solve? Okay, I will solve. Okay, don't worry. First, on 1/1/2009, we are going to split this 1000 rupees into liability and equity. That we can do. It's a 10-year instrument. Somewhere it is written 10 year. It's a half yearly instrument. So the number of periods will be 20 and the discount rate will be 5.5% and 6 monthly coupon will be 5% of 1000. That is 50 rupees. Is it right? So first what you do, write down step 1, calculation of financial liability and equity on the date of issue. Any way you present, but give me the answer. Calculation of financial liability and equity on the date of issue. So I will write here year, cash flow, present value factor at 5.5%. Why 5.5? Half yearly. 3 changes we will do in half yearly instrument. Number of year multiplied by 2, discount rate divided by 2, coupon rate divided by 2. Okay. So how many periods will be there now? 20 periods. Year write down, but in bracket write down 1 period is equal to 6 months. Half year. So 20 half years, 20 times this bond will generate 50 rupees coupon. And 20th year means after 20th half year, you'll get back 1000. Okay. Now I don't know the factor, you tell me, I will write accordingly. 11.9504. And this 20th factor is how much? 0.3427. Okay, no problem. Now kindly multiply. How much is that? Okay, we'll round off 597. Round off, no problem. 597, round off 343. Approximately. So your financial liability will be the total of this number 940 and equity will be 60. Sorry, 940, then answer is 60. Have you got this number right? Most of you. First find out the opening day figures. This equity will not change, it will remain 60. But this liability 940 will change every year. Interest accrued you will add and interest paid will be deducted, which you have done in homework also. Is it right? Buy interest to bank, buy interest to bank. So this you have to do 5 times so that you will be able to reach the carrying amount on 1/1/2014. After how many years they took the decision to redeem the bond early? 5 years. Is it 5 years? So there is a shortcut. If you want to prepare the account for 5 years, you can do that. Otherwise, you can simply calculate the present value at the end of year 5. Or you have to prepare the account for 5 years. What you want to do? Present value. Answer will be same. You can check as homework. Now we will calculate step number 2. Carrying value of financial liability after 5 years. We are right now talking about the carrying amount, means book value. So after 5 years, 5 years are remaining, 5 years are over, 5 years are remaining. So carrying value will be present value of future 5-year cash flow discounted at 5.5%. Is it right? So write down 10, 1 dash 10, write down 1 dash 10, 50. I will repeat again for those who have not understood. The total period is 20. 5 periods are over means 10, 5 years are over means 10 years are over. From here to here, 10 half years are remaining. We are doing the valuation of the bond at this point. So I have to calculate the present value of remaining coupon. And 10 write down 1000. Otherwise you can prepare a table. But that table will require you 10 calculations. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Because 10 half years are over. Your answer will be same. You can try as homework. Is it right? Anybody for 1 to 10 annuity factor? 5.5376. Okay, and this one 58. Okay, let it be. Multiply this number. Round off 377 you are getting. 585 you are getting. So financial liability is equal to, on this date, your carrying amount will become 962. Your carrying amount will become 962. If you prepare the account for 5 years, this is the balance you will find in your account. That is one way to get this number. Otherwise, simply find out the present value, because you are using 5.5% effective interest rate. And equity will be 60 only on this date. No remeasurement. These are the book value of liability and equity. This is the book value. Book value means ledger balance. What you did as homework. Of course, you have not done, but just for understanding, you have done. Similar thing you have done. Equity account remains same even after 5 years. Now what I'll do, this company is paying 1700 rupees to the holder and wants to redeem. We have to divide that 1700 rupees between liability and equity. For that, first I have to find the fair value of liability. But now the market rate of interest has changed to 8% per annum. 8% per annum means 4% for 6 months. Same calculation you do for finding the fair value on this date, the liability portion. Total fair value of the instrument is 1700. But out of that, how much is liability? That we can find out only again by computing the present value of remaining cash flow at 4% discount rate for 6 months. Okay, start. Step 3. This we will write step 3. Fair value of financial liability after 5 years. Fair value means in the market, at what rate this bond will be trading now. So 5 years discounted at market rate. I am using the same format every time. 1 to 10, 50 rupees, year 10,000. Year means half year, okay. Tell me the factor at 4% for 10 periods. Hanji, 8.1109, only 10th period. 676, no problem. Multiply. Make it 405, round off 676. Therefore, the fair value of liability on this date is how much? 10 1081. Fair value of liability is 1081. Total consideration paid is how much? 1700. So out of 1700, 1081 I am going to allocate it to debt. So how much I am going to allocate to equity portion? 619. So write amount allocated to equity. Same thing you have to do on early redemption also. Amount allocated to equity 1700, total consideration paid, minus consideration paid towards liability 1081, 619. Is it right? Now we'll write down journal entries. 2 journal entries will pass. Liability account debit, liability account debit. What is the book value you have calculated? 962. 962. P&L account debit. No. P&L account debit balancing figure. To bank 1081. 1081 is towards liability. 619 is towards equity. So anybody wants to volunteer? What is the loss? 119 approximately. And next entry, equity account debit 60, book value close, reserve and surplus debit balancing figure, and to bank 619, amount paid towards equity 559. So honestly tell me who got it right? Huh? So you could not reach that number. Okay, at least you tried up to this. अच्छा, वापस count again from 1st January 2009 to 31st December 2018. 9 years. 10 year. 9 or 10? 10. You ask that lady after the batch, how 10 year you have got? Take a calendar and check. Take a calendar and check. Okay, nothing to laugh about it. This is a usual mistake we make. 18 minus 9, 9 years. But one is 1st January, the other is 31st December. Okay. Okay, now, para 28. Foreign currency denominated convertible debt. Foreign currency denominated convertible debt. This time all features of convertible debt is there, but it is denominated in foreign currency. FCCB, foreign currency convertible bond. So bond is denominated in foreign currency. What this standard says, whether this is a liability or equity, conversion option is in foreign currency. Conversion option is in foreign currency. So when you will convert into reporting currency or what you call home currency, the exchange rate will be applicable. So if the exchange rate changes, there will be variable amount. So the standard says, because you are going to convert foreign currency into home currency, and because the rate of exchange changes, even the conversion portion will be treated as liability because fixed for fixed test is not satisfied. Okay. Fixed for fixed test matlab fixed amount of cash and fixed number of equity share. But because it's a foreign currency, on conversion into home currency, the value can change. So the standard says fixed for fixed test is not satisfied, and therefore the conversion option will also be treated as liability. This is an area where there is a difference between the standard IAS 32 and Ind AS 32. Ind AS 32 says this will also be treated as equity even if the bond is denominated in foreign currency, whereas this standard says this will be treated as liability. Okay. An entity may issue an instrument denominated in foreign currency, a currency other than the functional currency of the entity, that is convertible into a fixed number of ordinary share of the entity. So this is how FCCB works. You go outside your country and raise money from the foreign investor by issuing a bond which is denominated in their currency. For us, it becomes a foreign currency. Such an instrument contains a written option to exchange a fixed number of equity share for a fixed amount of cash that is denominated in a foreign currency. In foreign currency, the fixed for fixed test is satisfied. A fixed amount of foreign currency will be exchanged for a fixed number of equity share. But when you convert the foreign currency into reporting currency, the amount can change as the exchange rate would change. So therefore, this standard takes a view. It will be treated as a liability because foreign currency on converting into reporting currency can generate variable amount as the exchange rate will change. Ind AS takes a view. This will be treated as equity because Ind AS consider fixed cash in foreign currency. IAS 32 says fixed cash home currency and which can vary. This is a difference between IAS 32 and Ind AS 32. Remaining standard is same. A derivative contract over an equity's own equity is accounted for as equity only when it will be settled exclusively by the entity delivering or receiving a fixed number of own equity share in exchange for a fixed amount of cash. This we call fixed for fixed test. An equity conversion option embedded in a convertible bond denominated in a foreign currency to acquire a fixed number of entities' own equity instrument is an equity instrument if the exercise price is fixed in entity's functional currency only. Which means if the exercise price is fixed in any foreign currency, then it will not be equity, then it will be liability. For example, in the case of a foreign currency denominated convertible bond, the conversion component fails the fixed for fixed test as the fixed amount of foreign currency is not considered to represent a fixed amount of cash. So IAS has this view, Ind AS has a different view, and therefore your answer will change. Consequently, such bonds need to be classified as a liability in its entirety. Entirety means conversion portion will also be treated as liability. Is it right? Now we have almost reached the end of this chapter. Next part is treatment of interest, dividend, gains and losses and other items on liability and equity. So up to this we have covered the SOFP presentation. SOFP means balance sheet presentation. Okay, statement of financial position. Now let us see SOPL presentation, statement of profit and loss. If the underlying instrument is liability, then any payment made, interest, dividend, even dividend on a liability instrument will be recognized as expense. For example, preference share, which is treated as a liability. Henceforth, if you are preparing the financial statement under IAS 32 or Ind AS, you have to show the dividend on a liability in expense, P&L account, and any distribution to holder of equity instrument. If you have classified the instrument as equity, then any distribution made will be treated as appropriation and will be directly recognized in equity, that is statement of changes in equity. So dividend paid on equity will be shown in SOCIE. Okay. What about transaction cost? On equity instrument will be deducted from equity, and on liability will be shown in P&L account or depending upon the classification. If it is FVTPL instrument, then it is P&L account. But if it is FVT OCI or amortized cost, then it is adjusted in the carrying amount of the instrument and recognized by using effective interest rate. Okay. But more about that in the next chapter. Quickly, I have made a list of items which will be treated as income or expense. Interest payment on bond issued by entity, dividend payment on preference share classified as liability, gain or loss associated with redemption, which we did just now, 2 problems, or refinancing an instrument classified as financial liability. The previous 2 example of this category, gain and loss relating to carrying amount of instrument, that is financial liability, dividend from dividend that are non-discretionary represent a financial liability. Such dividends will be recognized as income or expense in profit and loss. Dividend classified as expense in P&L account may be presented either with interest or other liabilities or as a separate item. That is a presentation in profit and loss. And which item are not treated as expense but will be accounted within equity? Dividend payment on shares classified only as equity. Incremental directly attributable cost means transaction cost. This means transaction cost incurred in successfully issuing or acquiring an entity's own equity instrument. Okay. For example, when you issue equity share, you incur regulatory fees, amount paid to regulatory agencies, legal fees, people like you who extract lot of money from client, accounting professional and other professionals, printing of your memorandum articles, okay, prospectus cost, stamp duty. These costs associated with issuing or acquiring an entity's own equity instrument, either at the time of issue or at the time of what is called buyback, will be adjusted in equity. Other expenses will go to profit and loss. Okay. The amount of transaction cost accounted for as a deduction from equity is presented as per IAS 1 financial instrument, presentation of financial statement. Now the last few paragraphs. Treasury shares. What is treasury share? Buyback of share. Treasury share means buyback of own share. Can you buy back your own share and keep it in the financial statement as investment? In India, it is not allowed. But yes, in some countries, they allow you to acquire your own shares, right? So shares which are bought back are called treasury shares. In most of the countries, they ask that once you have bought back your own share, you cancel them. Okay, otherwise company will focus more on trading of their own share rather than doing their own business for which they were formed. So treasury shares will be deducted from equity. No gain or loss will be recognized in the profit and loss statement on treasury shares in the P&L account on purchase, sale, issue or cancellation of an entity's own equity instrument. Because it is your own equity instrument. You can't make profit by trading in your own equity share and show in P&L account. But if there is any difference, that has to be adjusted somewhere. So that will be adjusted within equity only. Similar to your buyback entries. Is it right? Such treasury shares may be acquired and held by the entity or by the members of the consolidated group also. In some countries, you can purchase your own share and hold it as treasury share. If you're a parent company, your subsidiary may acquire, or if you're a subsidiary, your parent may acquire your share and held it. Or one group company can hold share in other group company. So in consolidation, that becomes the treasury shares. Consideration paid or received will be recognized within the equity only. So with respect to treasury share, all entries will be made through equity. Is it right? Next question. Offsetting of financial asset against financial liability. A has to pay to B 1000 rupees. B has to pay to A 800 rupees. A has to pay to B 1000. B has to pay to A 800. How this will be presented in the financial statement? Can we show 200 rupees net amount? Or should we show 800 and 1000 rupees separately? Now the answer is it depends. Set off is allowed if and only if. So check it again whether following two conditions are satisfied or not. If the following two conditions are satisfied, then you show the net amount. Then it is like receiving the net amount only. Okay, but if these two conditions are not allowed, not satisfied, then you will have to present separately. So which are these two conditions? There is a legally enforceable right to set them off. There is a legally enforceable right to set it off. So suppose you are a debtor and a creditor. Amount payable can be set off against amount receivable. However, debtor is suppose in USA, creditor is in India. Then check whether legally you are allowed to set off. So what does your FEMA law says on this? Same party is a debtor in a foreign country. Same party is our creditor also. So many countries regulation says you can't do the set off. Bring the amount separately, pay the amount separately, so that the government will have a better control over this movement of foreign funding. Is it right? Can we set off in this case now? No, because your first condition has failed. Because there is no legally enforceable to set off. You have to receive 1000 separately, you have to pay 800 separately. Okay. So one has to look at the jurisdiction, whether it allows or not. Many times not allowed. Second, even though it may be legally allowed, do you intend to settle on net basis? Is the intention of the party to set on net basis or to realize the asset and settle the liability simultaneously? Even if not net amount, at least on the same day or same point of time, you receive and make the payment. Is it right? So there is a shop in the ground floor, AK Enterprise. Okay, all of you know, you take the Xerox there. Now, I know. We buy notebook, pen, pencil, stationery for our office. We also sell our books to him so that he can sell it to the student. So what do we do? Net amount or separate transaction? So we have a system of separate transaction. You give me check of your due, I will give you check of my dues. So unless you give me, I will not hand over you the check. So the parties can legally set off. We can legally set off, doesn't matter. But to have a better control over our accounting and for any future reference purpose, we don't do that. We have a system of separately paying each other dues at the same point of time. So even though I cannot do this, but I can do this. So legally this is allowed. This also I am doing. Say paying and receiving simultaneously. I can show the net amount. I can show the net amount. Okay. But suppose we don't pay on the same point of time. I pay much early. He pays much later. Or vice versa. So in that case, we are not intending to settle on the net basis and we are not realizing the asset and liability simultaneously also. Then the two amounts will be shown separately. Is it right? What is the logic the institute has given or the standard has given? In your note I have written, when an entity has the right to receive or pay a single net amount and intends to do so, it has in effect only a single financial asset or a single financial liability. It is as if there is only one amount because you are going to receive or pay the net amount only. One small question you solve and this chapter will be over. Entity A has a right to recover rupees 100 from entity B against sales and an obligation to pay rupees 100 to entity B against purchases. The amount is receivable and payable on demand. Can entity A set off the two amounts? So basically you have to write here, it depends on satisfaction of two conditions. So they have just asked you a provision of the standard in the form of a case study. Okay. So write down the answer like this. You don't write yes or you don't write no. You write down it depends on the satisfaction of following two conditions. And then you can present in any way your answer. So it depends on jurisdiction by jurisdiction basis. It depends on jurisdiction by jurisdiction basis. One will have to examine one will have to examine the law of the land and verify if there is a legally enforceable right to set off. If there is a legally enforceable right to set off. In addition, the criteria relating to intention also needs to be fulfilled before the amounts can be presented on a net basis in the balance sheet. Before the amount can be presented on a net basis in the balance sheet. Right? So this standard is over.